5,300 people got fired for doing exactly what their bosses told them to do. Some employees tried to report the fraud. They were the first ones fired. One executive walked away with $125 million. Years later, the FBI came for her anyway. The punishment lasted 7 years. It ended 13 months ago. This is why Wells Fargo employees secretly opened millions of bank accounts that weren't theirs to open. Real names, real social security numbers, fake permission. If you banked with Wells Fargo between 2011 and 2016, one of those accounts might have had your name on it, and you might never have found out. Wells Fargo fired 5,300 people for this. Not one, not 10, 5,300. One bad employee is a bad employee. 5,300 of them is not a personnel problem. That's a system, working exactly as it was built to. People inside the bank tried to raise the alarm years before any of this became public. In 2013, a banker named Bill Beto called Wells Fargo's own ethics hotline to report the exact fraud happening around him. He was fired 8 days later, officially for tardiness. He wasn't the only one. Another employee who reported suspected fraud to managers and the same ethics hotline was fired in 2010. Years later, a federal regulator awarded him more than $5 million and ordered Wells Fargo to give him his job back. The hotline built to catch fraud early was, according to multiple federal findings, being used to identify and remove the people who tried to use it. This wasn't an accident, and it wasn't a few bad apples. It was a slogan. Wells Fargo's internal mantra was, 8 is great. 8 separate financial products sold to every single customer, every single visit. Most competing banks averaged fewer than 3 products per customer. Miss the quota, and you could lose your job or your bonus. Hit it, and you got rewarded and promoted. There was no realistic way to sell 8 products in a single visit to customers who actually wanted them. So employees found another way. They opened extra accounts using real customers' information without asking, just to make the numbers on the sales sheet look real. Fake email addresses, fake PINs, signatures the customer never gave. This wasn't a few rogue employees. It was thousands of people across branches nationwide responding rationally to a system that punished them for failing an impossible target and rewarded them for cheating it. Business schools now teach this exact case as a warning about what happens when a company rewards a number instead of the behavior that number was supposed to measure. The bank's own CEO wasn't just setting that target from a distance either. He personally told investors about the bank's incredible cross-selling numbers on earnings calls as a reason to buy the stock, while his own shares gained more than $200 million in value over the same years the fraud was happening. This didn't happen for a few months. It ran for at least 5 years. When regulators finally forced a real investigation, the number of fake accounts kept climbing. First, it was 1.5 million, then 2 million. By the time the final count came in, investigators had found evidence of up to 3.5 million unauthorized accounts. A later internal review found something even more damning. 18.2 million of the accounts opened during that period had never once been used by the customer who supposedly opened them. Not one transaction, not one login, nothing, ever. The first real crack came from journalism, not regulators. In 2013, the Los Angeles Times published an investigation into aggressive sales tactics inside Wells Fargo branches, based on interviews with current and former employees describing exactly this kind of pressure. Wells Fargo publicly dismissed it. It took 2 more years, and customers themselves noticing strange fees on accounts they never recognized before the city of Los Angeles sued the bank in 2015. That lawsuit is what finally forced regulators to dig in properly. When Wells Fargo's own board eventually launched a full independent investigation, it reviewed more than 35 million internal documents and interviewed over 100 current and former employees. What it found was worse than the public scandal. Executives had known about versions of this problem since 2002, 14 years before anyone outside the bank found out. In 2016, Wells Fargo CEO John Stumpf was called before the Senate to explain himself. Senator Elizabeth Warren told him directly that he hadn't resigned, hadn't given back a single dollar of his own pay, and hadn't fired a single senior executive. Only the low-level employees who had no public relations team to defend them. Stumpf resigned within weeks. He later agreed to pay a $17.5 million fine and accepted a lifetime ban from the banking industry. He was never criminally charged. $185 million in fines and a resigned CEO. That should have been the whole story. It wasn't even close. Investigators kept finding more. Hundreds of thousands of car loan customers were wrongly charged for insurance they didn't need. Some couldn't keep up with the sudden extra payments. Up to 20,000 defaulted. Some had their cars repossessed over insurance they never needed in the first place. Among them were active duty service members, protected by federal law from exactly this kind of repossession. One Army National Guardsman had his car repossessed and sold at auction while he was preparing to deploy to Afghanistan. Then Wells Fargo tried to collect more than $10,000 from his family for the difference. Investigators eventually found more than 860 service members whose cars had been illegally repossessed this way. Wells Fargo had already paid $87 million for the exact same kind of violation back in 2012. It kept happening anyway. More than 100,000 mortgage customers were wrongly hit with late fees on top of it. Delays that were the bank's own fault in the first place. By 2020, Wells Fargo agreed to pay $3 billion to settle criminal and civil charges, the largest fine in the bank's history. For years, only the bank paid. The executive who actually ran the division where this happened did not. Carrie Tolstedt oversaw retail banking for nearly a decade, the exact unit where the fake accounts were created. When the board's independent investigators reviewed those 35 million documents, her name appeared 142 times. She declined to be interviewed for their report. In 2016, just before the scandal became public, she retired with an exit package worth roughly $125 million. Wells Fargo clawed back $67 million of it the following year, but no criminal charge followed. Not for years. Then, in 2023, Tolstedt pleaded guilty to a federal charge of obstructing a bank examination, admitting she had written a memo that deliberately understated how many employees were actually being fired for the fraud. She paid a further $17 million penalty and accepted a lifetime ban from the banking industry. She avoided prison, sentenced instead to 3 years of probation. Unlike Stumpf, who paid a fine and walked away, Tolstedt remains the only Wells Fargo executive ever criminally charged over what happened. Wells Fargo eventually eliminated individual product sales quotas across its retail branches entirely, the exact incentive that caused all of this in the first place. But the harshest punishment wasn't a fine, and it wasn't a policy change. It was something else. In 2018, the Federal Reserve did something it had never done to any bank before. It capped Wells Fargo's total size, banning the bank from growing any bigger than it already was until it proved the culture that caused this was actually fixed. That cap lasted 7 years, while rivals like JP Morgan grew by nearly $2 trillion in the same window. Wells Fargo was legally frozen in place, missing out on an estimated $10 billion in earnings, just sitting still while the rest of the industry grew around it. The cap wasn't lifted until June 2025. When it finally was, Wells Fargo gave every full-time employee a $2,000 bonus to celebrate. Not one of the 5,300 people fired years earlier got anything at all. Some people never even noticed a new account appear. Others got hit with overdraft fees on money that vanished into an account they never knew existed. Some watched their credit score drop over a card they never applied for, quietly enough to cost them a mortgage years later without ever knowing why. Some service members came home from active duty to find their car had already been sold at auction while they were gone. Nobody chose this. The only thing that decided whether it happened to you was whether you banked at the wrong place, on the wrong day, when someone needed one more account to hit a number on a board. Wells Fargo says its culture is different now, rebuilt from the ground up after everything that came out. The asset cap is gone, the fines are paid, and 5,300 employees who followed the incentive system exactly as it was built lost their jobs over it, while the system itself took over a decade to actually change. Next time you glance at a bank statement, it's worth actually reading it, not skimming past it. Because for millions of people, that's exactly the habit this whole thing depended on. It started with a slogan nobody outside the bank ever heard. This is the markup.